Hello everyone, welcome to JAIIB CAIIB English Medium. My name is Aarti and I hope you all are doing good. So as you know, this is our Manthan series where we are completing your ABFM all important topics. Along with that, we are also practicing on them. So remember one thing, if you are visiting to this particular channel for the first time, do subscribe it and share this session with your friends and colleagues so that they can also start their preparation for upcoming December 25 CAIIB exam. So now today we are going to talk about Unit-14, discounted cash flow valuation. Now in your JAIIB, in your CAIIB also, this part is very important. Yes, because when we talk about AFM finances or if we talk about CAIIB ABFM, the numerical part is majority of the times related to your time value of money. Yes, in your module B also we have covered this time value of money where we used to calculate NPV. Now this particular topic is similar with that concept only. Yes, so today I will explain you again what is this discounted cash flow and how you can solve questions based on them. So remember one thing, this unit is purely your numerical unit. So in exam when they want to ask towards the numerical side, of course they are going to ask the question from this particular unit. So let's start then today's topic. So first let's understand what is the meaning of discounted cash flow, DCF. Now as per discounted cash flow, DCF, this is a valuation method. This is a valuation method that estimates the value of an investment using its expected future cash flows. So here basically what you are doing, you are calculating your future incomes today's value. Now how we are doing this and why we are calculating this. Okay, so let me give you one example before I explain this particular discounted cash flow. See, suppose if I purchase today, okay, suppose today I am purchasing one car for rupees 10 lakhs. Yes, and if I ask you, because you have the good knowledge about the cars, about their income sources, so I asked you that if I purchase today car by paying rupees 10 lakh rupees, so for how many years I can generate the income and what will be my income? So you told me you can generate income for 1 to 5 years. This is my 0 time period, 1, 2, 3, 4 and 5. Yes, during this 5 periods, every year I can generate 1 lakh, 1 lakh, 1 lakh. Okay, this is what I have received the answer from you. Now as a layman, generally if I ask what is the total income from this particular car, what you will do, you will add all this 1 lakh, 1 lakh, 1 lakh and finally 1 lakh and total you will say total 5 lakh you will earn from next 5 years. Yes, generally we do this, correct? But as you know, inflation, GDP, yes, everything is day by day that is increasing because of this inflation part. Yes, so this is not the true value. This 5 lakhs which I am going to generate in future, that is not my true value because I have not added any inflation amount in this particular 5 lakhs. Correct? So basically as a layman, always we calculate like this. We generally add the future incomes and we say this is our total income. But this is wrong. This is wrong because every year you can say prices of the products or services that is actually inflated. Yes, every year that is inflating from time to time. So we need to adjust based on that inflation also. So for that inflation part, we are going to add this inflation part in this incomes. In this incomes, we are going to add this inflation part. Correct? Now, for calculating, for adjusting this inflation part, we are going to use here time value of money. Time value of money we are going to use here. Now when we use this time value of money, so see how the calculation will change. So again I am saying that I am going to purchase a car and I will pay today, in my 0 time period, that is 10 lakhs. I am going to pay today 10 lakhs. Okay. From this investment, every year I am going to generate. Now, suppose 2 lakhs. 2 lakhs 2 lakhs, 2 lakhs and 2 lakhs. Yes, so 1, 2, 3, 4, 5, 6. For 6 years, I am going to generate 2 lakhs per year. Means total I am going to generate 12 lakhs. Okay, if I ask you what will be my total income after 6 years, you will say 12 lakhs will be your total income. But this is not true because in this particular equation or in this particular example, till now we haven't added any inflation. Yes, so now when we are using this time value of money, okay, when we are using this time value of money, we are going to use one rate. We are going to use one rate here. One rate we are going to use here, and whatever future incomes we are generating, we are going to discount it, and we will calculate the amount for your 0 time period. Yes, we will add all your future incomes by applying one rate, and we will calculate today's amount. Like if I calculate 2 lakhs after 1 year, what is the true value if I receive today? Because whatever amount I am receiving today, suppose if I am paying rupees 100 today to purchase one pen, tomorrow or after 1 year, the same pen will not cost me rupees 100. This will cost me 110 for one pen because of inflation. Or if I am going to pay 10 lakh rupees 100 for one pen, might be I am not receiving the same benefit that I used to receive before 1 year. Yes, so this is what the inflation is actually affecting us. Yes, so here, whatever the future incomes we are calculating, we are discounting. We are using one rate, and with this rate, we are discounting it. And after discounting it, like I will bring this 1 lakh, this 2 lakhs 1 year back. I will bring this 2 lakhs 2 years back. This 2 lakhs 3 years back, this 2 lakh 4 years back, here again 2 lakh 5 years back, and finally this 2 lakh again 5 years back. So remember, I will calculate 0 time period amount. Okay, 0 time period amount I am going to calculate here. So this is what discounting talks about. Discounting says because of the inflation, whatever amount you are receiving in your future, you are going to calculate their today's value. What is their today's true value for valuation of the project? So this is your discounted cash flow. So discounted cash flow is a valuation method that estimates the value of an investment using its expected future cash flow. Now, analysts use DCF to determine the value of an investment today. Today we want to value. See, whether to purchase that vehicle or not, whether to buy gold or not. Today I am going to make a decision. Yes. So how I am going to make a decision? By estimating futures cash flow. With that futures cash flow, I am going to estimate today's value. I hope everyone understood this part. Yes. So this is what discounted cash flow. Correct. So analysts use DCF to determine the value of an investment today based on projections of how much money that investment will generate in the future. So this is your DCF. Now under this DCF, we have one model known as dividend discount model. Correct. Now if you want to value today about any project, there are different ways. Either you check the cash flows, or you can use the dividend side. Yes, how much the company will pay you as a dividend. So through that, when you are calculating, under that we have different methods. So again, I will explain what is this dividend and how we are going to evaluate. But I am just giving you a quick brief that if you want to value any company's true value, what you can use through that dividend you can calculate. Means what? See, here, for example, if you are investing in Reliance Industry today, rupees 5 lakhs. This is the amount you have invested in this Reliance Industry. Now, this Reliance Industry will give you, 1, 2, till 10 years. Every year, this Reliance Industry will give dividend rupees 25,000. For next 10 years, this Reliance company, after investing 5 lakh, will provide you 25,000 each year. Now, whether this investment is beneficial or this is actually a beneficial, a good type of a investment or not, we want to calculate that. Correct? So how I can calculate? I can, as a layman, if I don't know the time value of money, inflation, what I will do, I will just take 25,000 per year I am going to receive. So just multiply with the 10 and the amount is going to be 2,50,000. I can do this. But after knowing that there is some thing known as inflation, I cannot do this. I cannot do this. Yes, I need to calculate with the inflation. Yes, I need to calculate whatever dividends I am going to receive in future with the inflation, and that will be my true amount. Now, how I can calculate that part? I have different methods. Okay, as a company, if I am investing, yes, this is my investment. This is investment. And how much return I am generating each year? 25,000 is my return here. Correct? Now, if I want to know the true value at a 0 time period, what I will do? I will calculate here discounted cash flow. Now, discounted cash flow under this dividend discount model, we have 1, 2, 3, 4, 5. 5 ways through which you can calculate. Again, I am saying first one is a constant growth model, second is zeroth growth model, third is your 2-stage model, D is your H model, E is your 3-stage model. These are the 5 different ways through which you can calculate dividend discount model. Correct? Now, let's start with the first one, that is constant growth model. Constant growth model. Now, again, let's take one example and let's understand this topic. This is a Tata company. Correct? Now, as an investor, I want to invest in this company rupees 4 lakhs. Okay, I invested rupees 4 lakhs in your 0 time period. Now, this Tata company says that if you invest today 4 lakhs, first year, second year, third year, fourth year. Okay, after investing this 4 lakhs, you are going to generate income in your first year, suppose that is your 80,000. Then second year, 1,20,000. Then third year, suppose you are going to generate 70,000. And finally, in your fourth year, you are going to generate, suppose, 50,000. Correct? This is the one way this Tata company can say. Or the Tata company can say that every year, yes, if you invest today 4 lakhs, this is the one way they can say that this much investment we are going to provide. Or they can say that if you invest today 4 lakh in your first year, in your second year, in your third year, correct, you are going to generate, suppose first year you are going to generate 80,000. Yes, second year you are going to generate 1,60,000. Third year you are going to generate 2,40,000. Correct. Then so on, if we continues, this amount will just add by 80,000. You can see every year you can see plus 80,000 we are getting. Yes, plus 80,000 we are getting. Plus 80,000 we are getting. Yes or no? In your fourth year, if you continue your investment, you will receive, suppose, 3,20,000. So this is how your investment is actually looking. Yes, every year you can say that every year you are getting 80,000, 80,000, 80,000, 80,000 on whatever amount you are receiving in your previous year. So if you observe this type of investment, yes, why I have made 2 types of, here projections. This one is your A projection, this one is your B projection. Company can say we are giving you this type of dividends, and company can also say every year you will receive 80,000, 80,000 extra on your invested amount. So if company is going with the B, option, yes, if you invest in Tata company 4 lakhs and company saying every year whatever your previous investment we have made, on that we will give you extra 80,000 and same 80,000 will continue till the life of that investment. If this is the flow, if your dividend every year is increasing, yes, 80,000, 80,000 and 80,000, then that is your constant growth model. You can say here 8 plus 80, here also plus 80, here also plus 80. Means you are seeing the growth. Hana, you are seeing the growth. Your amount is increasing. Na? First year you received 80,000. Correct? Second year you are going to receive 1,60,000. Third year you are going to receive 2,40,000. You can see there is a growth. Of course there is a growth. Yes, there is a growth. But you can see one more thing, that this growth is always by 80,000 only. This growth is always constant. This growth is always constant by 80,000. Correct? So what constant growth model talks about? When your growth is there, when your amount is increasing, but with the same amount, if that increases, that is your constant growth model. So one of the most common assumption used by dividend discount model is that the dividend paid out per share would increase at a rate that is fixed. Every year on your FD amount, you are going to receive 6% on your invested amount. So that is what? That is your constant growth model. I'm not talking about compounding part. Okay, I'm just saying whatever the basic investment you have made, on that if you are getting the same amount, yes, that is what? That is your constant growth model. Now remember the formula. This formula is very important, and this topic is also very important. In exam they are asking directly question from this topic. So the formula that you can use here, that is D1 divided by R minus G. Means if I want to know that whatever the incomes I am generating after the investment, and by that investment I want to know the true value of that shares or that investment, I can use this method. Now I will explain one by one about this terms. D1 means the dividend received next year. Okay, next year dividend. Then R means your rate. G means that growth rate. So P is what? P is your price. P is your price. Okay, price in your 0 time period, dividend in your next year, dividend in your first year, yes, in your second year. Means your future dividend they are going to use as a numerator part, divided by R minus G. R means your rate, G means your growth rate. Yes, so this is the formula we are going to use in case of constant growth model. So let's practice one question based on this. So XYZ Limited is expected to pay a dividend of 3 per share 1 year from now. What we are reading here, let's make an analysis. XYZ Limited is expected to pay dividend 3 per year 1 year from now. This is a 0 time period, and they are saying after 1 year, yes, after 12 months, you are going to receive dividend in a first year, that is rupees 3 from now. The dividend payments are expected to grow at a 5% per annum. Means if I make a graph, first year if I am receiving 3, second year I am going to receive 3 plus 3 into 5%. Yes, in a second year. Then third year again it will increase by 5%. Fourth year again it will increase by 5%. So you can say there is a constant growth. Every time 5% will multiply. So here your growth is equal to what? Your constant growth is equal to 5% per annum. So if an investor needs 12% rate of return, now as an investor, how much return I want, that is given by R. That is a rate of return 12%. So what price of the share will be considered to be fair? Now what price we are going to calculate, what is the actual price, what is the true price of this investment. For that you can use D1 divided by R minus G. So D1 is your, yes, that is a 3. Already they have given. D1 means your next year dividend. R means your rate of investment, that is 0.12. Growth is your 5%, 0.05. So here if I solve, 3 divided by 0.07, your amount is 42.857. This is the true value. This is the true value of your investment. This is what constant growth model talks about. Okay, this is how we need to calculate constant growth model. Okay, coming to the next question, same concept we are going to apply here. So if a company's dividend per share is ₹5, the required rate of return is 10 and the dividend growth rate is 4%. What is the stock price according to the model? Now again, let's use the same formula. Dividend that you are going to receive after 1 year divided by R minus G. So here D1 is what? D1, company's per share dividend. If a company's dividend per share is 5% and required rate of return is 10% and the dividend growth rate is 4%. Okay. So here this ₹5 is your present dividend. Okay, this is your present dividend. But here we want future dividend. Yes, we want future dividend. Now how you can calculate? For calculating future dividend, you are going to use your current dividend multiply with your growth rate. Okay, in exam they can frame this question also. So you need to calculate future dividend because in formula we require future dividend. So if they are giving you present dividend, as the statement is saying is ₹5 means they are talking about present year only. So 5 plus G, 1 plus G, that is growth rate is what? That is 4%. So 0.04. 1.04 into 5, this is 5.2. This is the D1. So 5.2 divided by R minus G. R is your 0.10, then growth rate is 0.04. 5.2 divided by 0.6. Rupees 86.67. This is answer. Just now we have seen one more formula like how you can calculate your D1. Okay, either they can give you a direct question or they can give you the present dividend and based on that you need to calculate your future dividend. Now how to identify whether that dividend is your present or future? In D1 they are going to talk about like next year. Yes, they are going to say future or they can say paid next year. This type of terms they are going to use, and if they are using this type of terms means that is your future dividend. But if they are using current dividend, yes, or previous dividend, yes, if they are using this type of terms, correct, currently paid dividend, this type of terms, or is if they are using all these things, if you are using here, then that is your present dividend. Means they are talking about present dividend, that is D0. So remember, this is how you need to identify which type of dividend they are asking. So in today's session we have completed about constant growth model. Now remember, if you want to practice this zero growth model, 2-stage H model, 3-stage model in your November 24, they have asked one question based on this 3-stage model, but 3-stage model is quite lengthy. So if you want to cover all this remaining models along with their formulas, along with the practice, you can join my paid batch. Now remember how you can join my paid batch. Let me help you in that. You need to just visit to the 24/7. This is our official website. Click on our first link, all courses JAIIB CAIIB, and CAIIB December 25 is your attempt. Now you can see here you have Mahapak, JAIIB Increment Mahapak, and you have Officers Pro batch. Now in this particular batch we are going to provide you all 4 compulsory subjects, live classes plus recordings plus mock tests plus e-books. Yes, for your continuous revision, for your practice, we are going to assign you this particular batch. Now for purchasing this batch, click on a buy now. But remember, don't pay directly 5,565 rupees. Now, why I'm saying that? Because you can reduce this amount. You can save some amount if you use one coupon code Y895. If you use this coupon code, if you apply, you can get the higher discount amount, and then you are going to pay only 5,060 rupees. That is the benefit when you use the coupon code, that is Y895. And remember, start early so that you can practice, you can understand the concepts, because CAIIB is not that much easy as your JAIIB. Correct? So with this, now I'm winding up this session. So thank you everyone for joining. Take care and bye-bye.